Hello friends, I think it's time to wrap up the theoretical part of our Options Are Easy series and move on to full practice. We will build option strategies in real market conditions, trade, learn and earn. Today we have the final lesson with the beautiful number 20. This lesson I want to devote to the profitability and risks of option strategies. This is an important thing to understand your money management, risk management, and just knowing how much you can earn. I suggest starting with something simple. Options is vastly superior instrument than linear instruments and more complex too. You can see this even with the simple vertical spread strategy. A month before expiration, and the trader expects that in 1 month the Bitcoin price will rise above 30k. Which is quite possible. What are the risks of this strategy? The maximum risk is equal to the size of margin requirements. The debit paid for the strategy is $189. What kind of return can this strategy bring? We already know that the potential profit is equal to the distance between the strikes minus the margin requirements. The total is $811. The risk-return ratio is 1:4. The return for 1 month is very high, about 400%. But in order for such strategies to bring profit, there must be some strong price movement, but it may not happen. So strategies like buying volatility. Okay, let's create one. I'll open another option chart window and create, for example, a bot straddle. For ease of calculation, I'll work with 1 Bitcoin. I buy put options and call options. The profit is kinda unlimited. How much can it bring? With margin requirements of 1,338. If the price rises to 32 or falls to 22, the straddle will bring $3,000. Accordingly, our profitability is 200% if such movement occurs. How to lock in such a profit? Simple. You can do it here. Sell the futures. When the options go deep into the money, of course, the put options will lose all their worth, but the call options will go deep into the money. In this case, we can just sell the futures or sell the put options, and then we can synthetically close our position. But we probably won't need to buy put options at strike 27. We will lock in a profit one way or another if there is a major price move. But again, for this to happen, there must be a serious price move. And then the options will demonstrate a high profit of hundreds of percents. And now let's consider selling options. Such strategies are more popular because they can generate constant income. I'm now opening another option chart window, a simple strategy, the sold strangle. Now I sell options. Let's say put options at strike 25 and call options at strike 30. And there's our sold strangle. The situation here is more complicated. If with bought options, buying options dominates. Although in the past strategy we could have sold the following strikes. For example, we could sell call options of strike 31 and we could also sell put options at strike 25, like this. But still, in this strategy the main role takes buying, because the central strike is bought. We can buy only one side, and then if there is a growth, the income will be 100% of the margin requirements, over $1,000. But if there is a fall, the return will be $3,000, $4,000, $5,000. When buying, it is easier to assess the risks, because the maximum loss is the premium of the bought options minus the premium of the sold options. But with selling, naked selling, when we don't have a risk limit. Okay, you probably realize that no sane person would sell options without some sort of risk management plan thought out in advance. There's hedging. When the options go in the money, the price of Bitcoin gets above 30k, the trader turns on the delta hedger. If the price falls below 25, he too limits his risk with a delta hedge. Delta hedger neutralizes market risks by bringing the delta to zero. In this case, if the price falls, the hedger sells futures, and if it rises, he buys. Or a purchase of fast strike options is made to limit the risk. Okay, this strategy will bring us $484 of profit if the price stays in this 25 to 30,000 range. The margin requirements are 3,730. Of course, margin requirements are always higher when selling. If you want to calculate the profitability based on margin requirements, it will not be quite correct. If you calculate it roughly, it is somewhere around 15%. 15% return for a month is a good return. Calculate your profit for the year. You will get more than 130%. One more thing. If you have invested all your funds in margin requirements, then at any jump in volatility you can get a margin call. The danger of forced position reduction is another risk factor, and it must be considered. There are no liquidations on the AE exchange. No one will turn your account to zero, but the position will become smaller. So you should not consider GM as a determining factor to count your income. When selling options, it is better to target 20-30% of margin requirements. The maximum is 50%, but no more than that, because this is the way to margin call. In this case, you will not get such income. In my experience, I will say that the return on sales is usually 5-8%. But when selling naked options, you can optimize your selling by buying some far-out strikes. For example, I'll buy put options of strike 23 and put options at strike 32. They're cheap and will end up with, an iron condor. But the name of the strategy is not important. What's important is that we have now more than halved our margin requirements. $1,510. The maximum profit has been reduced accordingly and is now $387. But the percentage of return has increased, $387 from $1,510 is about 25% return. Always remember that you can reduce your risk by buying additional leverage, cheap long-distance options. And don't forget that when you use delta hedging, you also reduce your margin requirements. You can try out all the ways of doing it here, in the desktop terminal and in the web terminal. Before entering into any option strategy, clearly assess the amount of return and risk for yourself. Only you can say whether you are satisfied with these indicators or not. Options are a serious instrument that has high risks but also high returns. If someone tells you about high returns without mentioning the risks that always exist, you're most likely being misled. I think this is where we end our theoretical learning cycle and move on to the practice. I think we need to devote a line of lessons to the use of trading robots. There are advanced trading robots in the AE terminals that allow you to make money when there's a price movement or when there's not. If you have any questions, please ask them in the comments. If you found this video useful, leave a like, subscribe to the channel. I wish you all the best and successful options trading.